Welcome back, part 3. Okay, so I wanted to give you a real life example of how an annuity would work or when you see one. So if you've ever gone to buy a lottery ticket, one of the questions they ask you is, do you want the cash payout or an annuity? I think there's a default, but you have those two choices. And what do people pick? They pick cash, right? I want all my money right now. I don't want to worry about a 30-year annuity. I want it now. Well, let's get into that a little bit. So there's no right or wrong answer as to whether or not now is better than, all at once is better than long term. I mean, you do see those shows about people who, lose all their money within like a year or two. So maybe the 30-year payout's a better option just for life, just to manage it better. But from a financial standpoint, let's look at the differences here. Okay, so I looked up on April 12th, 22. A lottery winner in New Jersey could choose between a $106 million annuity for 30 years or a cash payout of $65,300,000 all at once. Well, why is there a difference, right? Why is it 106 to 65? People normally look at that and they're like, wow, look at all the taxes on that. That's not even remotely taxes. Taxes aren't even part of the conversation yet, okay? It's because of the time value of money. Because if you're getting all of that money today rather than spread out over 30 years, you're going to get less because you have to discount it back to today's dollars. All right, let's look at how much of a difference there is, right? The annuity is going to pay out $106 million a year for 30 years. That's $3,533,333. Let's just go 3.5 million per year would have been the even payout over the next 30 years. Okay, cash payout $65,300,000. Like, you're going to get it all if you choose the annuity. You're getting the full payout of $106 million. Then you get to pay taxes later. But the cash payout is $65,300,000. That's a $40 million difference. Why? Time value of money. Okay, so I have a lot of gap. Well, kind of give you a timeline, right? You could remember the timelines we did in the previous example here. All right. At this point, if you're watching my videos, you wouldn't expect my line to be straight, right? So realize you've got a payout, blah, 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 right? For the next 30 years, let's pretend those are nice and even, and you're getting a $3.5 million payout every year for the next 30 years, right? Now the idea, right, 3.5 million per year is your payout. The idea is we have to bring all of those different payouts for the next 30 years back to today's dollars for the people who want the cash payout. Okay, so you remember we did this in the previous video here, is that we saw that annuity gets brought back 1 year, right? Every year for the 30 years out to come up with the amount. But since it's an even dollar amount, we can use the annuity table. All right. I cheated a little bit and did a little bit of work off screen. You're not supposed to see all that yet. I did a little bit of work off screen, and I calculated that if the present value, I did it in Excel, if the present value was $65,300,000, right, that is today's value. This was year zero. Oh, just took it away. The present value is $65,300,000. The annual payment would have been $3,533,333 for the next 30 years. So like I said, I did a little Excel math and calculated that the interest rate the state of New Jersey is using is 3.46%. It's not terrible. I mean, it's actually decent right now. I don't know whether or not they change the rate to go along with the market as they go along, but I guess they wouldn't, right? Because they discount it all back to today. But anyway, point being is that if you felt you could invest that money better than 3.46%, you could earn 6%, 5%, then it makes sense for you to take the $65 million in cash today and invest it and earn that money. If you feel like you couldn't do as well as New Jersey's 3.46%, then leave it in the annuity and collect it over the next 30 years because that interest rate isn't so terrible right now based on how numbers are, how the interest rates are currently. So just to kind of prove it to you that it works, if you were to put $65.3 million today into an investment, too many days there. Here, we'll get rid of that one. Into an investment today that earned 3.5%, then you would have that same payout of $106 million. You would match New Jersey. Now, how do you even see that you can do that? Well, I real quick just looked up present value of an annuity calculator. Okay, and I like the look of this one the best. just to illustrate to you guys. They almost all have the same setup here. They have it set up on the side. Let's say the payment amount we know is $3,533,333. The interest rate, 3.46%. We're looking at 30 years, compounding annually. Look at that, $65,300,000. So we have just calculated that that is in fact the case. New Jersey is using 3.46% to come up with the present value in today's dollars of $65,300,000. So now the next time anybody that you know plays the lottery, you know what's going on. You know why there is a cash payout difference from the annuity payout. It's all about the time value of money and discounting the future values back to today's dollars. Okay, I thought it was neat. All right, impress your family. Okay, so let's talk it finally. Let's talk about the net present value method. All right, so this all lends on these same principles that we've been looking at. I've got to move myself. I'm totally in the way. There we go. All right. The net present value method, what you do is we're going back to capital investment analysis now, no more lottery talk. You compare the amount to be invested today with the net cash inflows that you're expecting to receive from the investment. Ignore this for right now. We'll get into what that means in a minute. Here's our example. We're looking to buy a new piece of equipment for $200,000. We're expecting the equipment to last us for 5 years, and we want a 10% return on this equipment, right? We want it to generate cash flows of 10%. So each year, we expect the equipment that we're buying to generate these cash flows. $70,000 first year, 60, 50, 40, and 40. In total, the equipment is going to generate for us $260,000 of cash. And we're only going to spend $200,000 on it. Okay, so now you would think, great, I'm going to make $60,000 by investing with this piece of equipment. Not quite, because this $260,000 does not factor in the time value of money. Now you can look at this little box here, right? It may seem like a good deal, but if you just look at those numbers, you're not calculating the time value of money. So what I'm going to do and show you to do is we are going to work our way backwards on these. We are going to walk this $70,000 back to today's dollars. Take the $60,000 that's going to be earned 2 years from now and bring it back to today's dollars. Right, here we go, $50,000 back to today's dollars, 44 years out to today's dollars, 40,000 5 years out to today's dollars. Now you can go to the tables. You can't use the annuity table because the dollar amounts are different from each year to year, which is pretty usual for something like this. What I'm going to do is I'm going to go to 10% in 5 years. Ooh, still have that open. 10% in 5 years. I think that's, nope, that's the annuity table. There you go. 10% 5 years. Oh, sorry. 10% 1 year out. Oh, I'm off of the row. 1 year out, 2 years out, 3 years out, 4 years out, and 5 years out. I'm going to grab those numbers and I'm going to multiply it by each one. 1 year from now, that $70,000 a year from now is really worth $63,000 to me in today's dollars. $60,000 2 years from now is worth $49,000 to me in today's dollars. 50, 40, 40, right? Each one I'm walking back to today's dollars. What is it worth to me today? So even this last year, 5 years out from now, that 5th year is really worth, that $40,000 is really worth $24,840 to me in today's dollars. So what I do is I take all the future cash flows, bring them back to today's dollars, add them together, and I wish they added them together. You would come up with $202,900 in today's dollars. And if I'm going to put out $200,000 to buy this equipment, I'm still ahead. I'm ahead by $2,900, right? Because my future cash flows are going to exceed my current expense of $200,000. There you go. There's the net present value of the investment. I'm going to be ahead by $2,900. All right, so hopefully that makes sense to you as you go through these. Ugh, my hair's too short for this. Okay. All right, the pros of the net present value method. You consider the cash flows, you use the time value of investment. Cons, it's more complex, obviously, right, as we just saw. Now here's one thing. If you're trying to make a decision on the present value method between different proposals. Let's say you've got 3 proposals, and I left this in here as an example for you, not for you to calculate, which you could do pretty easily, but really for you just to look at. A present value index is where you rank different proposals based on their present value index. Basically, how much are they going to generate for you? Okay, you see, we'll put it here. So I'll show you the math in just a second. You've got the total present value of the net cash flow divided by the amount to be invested. Okay, so this is a ranking system. The total present value of the cash flows of the example we just did is $202,900. The investment, $200. So it ranks a 1.01. Okay, the idea is it's more than 1, so you're good, right? It's generating more cash than the investment. So if we had 3 proposals as an example, pulling away from these numbers just for a second, and you've got the same kind of thing, they're just telling you the present value of the cash flow divided by the amount to be invested. So you're just taking 107 divided by 100,000. There's your 1.07 is the ranking of that proposal. Proposal B, what if we spend our money with Proposal B? 86.4 divided by 80,000, 1.08. That is a better return on my investment, right? Present value index is higher. Proposal C, it's going to cost me 90,000 to invest here, Proposal C, but I'm not going to get my money back in the sense of the present value of it. It's 86,400. So with that being the case, you're actually less than 1. Proposal C, it's off the table unless you really need to do Proposal C. You know, there's other considerations, but if you're just looking pure numbers, Proposal B is the way to go because it's got the highest present value index. Okay, so I'm going to get into a couple of short examples and then we're going to wrap this chapter up. All right, so just come back to me for part 4.